We're often told that successful investing is all about finding the next hot stock or timing the market perfectly. But what if I told you the real secret is about understanding just a few simple data-backed principles? Well, in this explainer, we're going to cut right through all that noise and show you what the evidence actually says about building wealth.
Okay, let's start with the dream, right? Imagine you invested just one single dollar in the US stock market way back in 1926, and then you just let it ride. With all the dividends reinvested, today that $1 would be worth over $1.8 million. That's the absolutely incredible power of long-term compounding.
But, and this is a big but, here's the price of admission for that dream. To get that spectacular return, at some point along the journey, that same portfolio would have lost more than half its value. Yeah, it would have been slashed by a staggering 58%. And that, right there, is the fundamental dilemma every single investor faces. How do you capture all that incredible upside potential of the market without getting totally wiped out by the downturns that you know are coming? Well, professional asset management is basically the science of solving that exact puzzle. So let's break down how it's done, starting with the cold, hard data.
Right, so before we can even think about building a strategy, we have to understand the battlefield. And the only way to do that is to look at the data, putting all the emotions and the scary headlines aside for a minute. And the data, going all the way back to 1926, is crystal clear. Stocks have delivered the highest long-term returns by a massive margin, clocking in at an average of 10.4% per year. I mean, look at bonds and cash, they're not even in the same league.
But of course, those higher returns come with a cost, and that cost is volatility. We're talking about some pretty wild swings in value. The data shows stocks are more than twice as volatile as bonds, so you're in for a much, much bumpier ride.
So here's the crucial point to really let sink in. These gut-wrenching downturns, where the market drops 20% or more, they aren't rare once-in-a-lifetime events. Nope. The data shows they're a regular, almost predictable feature of investing in stocks, happening on average about every 3.5 years.
So, given that brutal trade-off between high returns and high risk, how do the pros manage it? Well, the answer comes from a Nobel Prize-winning idea from way back in 1952 that's still the absolute cornerstone of modern investing. This is the math behind diversification. And it's not just about owning a bunch of different things. It's about owning assets that zig when others zag. The whole idea is to build a smarter team of investments, not just trying to pick a few individual star players.
And look, this isn't just some catchy phrase from Harry Markowitz, the guy who pioneered the math. The historical data proves, without a doubt, that this thing actually works in the real world.
And this chart just illustrates the power of that free lunch perfectly. By adding bonds and giving up just a little bit of that top-end return, the classic 60-40 portfolio cuts its volatility almost in half. And maybe most importantly, it dramatically reduces that worst-case loss. Now, I know you've probably heard the headlines screaming that the 60-40 is dead, but that really misses the point. The core principle that combining different types of assets improves your risk-adjusted return, that is as powerful today as it has ever been.
Okay, so diversification is our foundation for managing risk. We've got that. But what about beating the market? That's the holy grail, isn't it? Can't you just hire some genius manager to pick all the winners and skillfully avoid the losers? This is the promise of what we call alpha.
Well, the evidence here is pretty overwhelming. And frankly, it's kind of disappointing for a lot of people. Over the long run, the vast majority of professional active fund managers actually fail to consistently beat a simple, low-cost index fund. In fact, a staggering 2/3 of them fall short. And here's the real kicker. Even when you find a skilled manager who does generate what's called gross alpha, the fees often eat up almost all of the gains. So imagine this. A manager finds a 2.6% edge, which, by the way, is incredible skill. But then, after you subtract their management and performance fees, the investor's actual net gain can shrink down to almost nothing. The fees literally consume the skill. This is really the central argument in the whole active versus passive debate. And you know what? The big money has definitely noticed. Investors are voting with their wallets. The flow of capital out of these expensive active funds and into cheap passive index funds, well, it's become a tidal wave. We're talking hundreds of billions of dollars making the switch. So, after we've looked at all this data, what are the big takeaways? What should you remember from all this? The evidence really boils everything down to 5 clear, data-backed principles for building a solid investment strategy. First, and this is so critical to get, taking on more volatility is just the price of admission to the market. It is not a golden ticket to guaranteed profits. You are being compensated for taking on uncertainty, not for some sure thing. Second, you have to embrace the only free lunch in finance. Intelligently combining different assets that don't all move in the same direction is the single most effective way to smooth out your investment ride and protect your portfolio from those really brutal downturns. Third, be absolutely relentless about costs. Think about it. Market crashes are temporary, but fees are forever. They're a constant, guaranteed drag on your performance, and the data shows they are the single most reliable predictor of what your future net returns are going to be. Fourth, you've got to accept volatility. You just have to. The data shows us again and again that staying disciplined and sticking to your plan through those inevitable, painful downturns is precisely what separates successful long-term investors from the crowd that panics and sells at the absolute worst time. And finally, number 5, trust the evidence. Base your entire investment strategy on decades of hard data, not on today's scary headlines, not on some persuasive stories someone tells you, and definitely not on some guru's bold prediction about the future. And all of this really brings us to one final provocative question for you. The principles of sound, evidence-based asset management. They aren't some big secret, and they're not that complex. They just require discipline. So take an honest look at your own approach. Is it truly designed to weather the inevitable storms, or is it just built on the hope for sunny skies?